Listen to me very carefully. In April of 2026, one of the wealthiest nations on the face of this earth, a country sitting on hundreds of billions of dollars in reserves and trillions more in sovereign wealth, walked up to the United States Treasury and asked for a financial lifeline, and buried underneath the carefully chosen diplomatic language, underneath the polished press releases and the closed-door conversations, their message was brutally simple: help us, or we will have no choice but to crash your bond market. That country was the United Arab Emirates. And almost nobody, not the financial media, not the analysts on television, not the people who are supposed to be watching this, understood what was actually happening. I do, and for the next 25 minutes, I am going to tell you exactly what it means, why it will define the next 12 months of your financial life, and most importantly, what you must do before the next domino falls, because it is already falling. The only question is whether you are standing in front of it or behind it. Before I go any further, I need something from you. If you are new to this channel, stop what you are doing and hit subscribe right now. Not because I am asking nicely, I don't do nicely, but because what I am about to give you is the kind of strategic intelligence that financial advisors charge thousands of dollars a year to deliver, and most of them still get it wrong. The information in this video alone could protect your mortgage, your retirement account, and your purchasing power from a crisis that the majority of people will not see coming until it has already taken their money. Subscribe, hit the bell, do it now, and then stay with me, because this is going to matter. To understand why the UAE's move is so significant, you need to understand the architecture of a system that has quietly governed global finance for the better part of 80 years. And I want to be very clear with you about something before we begin. I don't care about your feelings on America's debt. I don't care if you are a patriot who refuses to believe the United States can be vulnerable, or a cynic who thinks the whole system is already rigged against you. I care about your money, and the numbers don't lie. Here is the cold reality of how the United States government operates. Every single year, not occasionally, not during a crisis, but every single year, the United States government spends significantly more money than it collects in taxes. We are talking about trillions of dollars annually. In practical terms, this means that the government must borrow the difference, and it borrows that difference by selling what are called treasury bonds, essentially IOUs, legal promises from the United States government to repay the holder in a fixed number of years with interest attached. Now, a 10-year treasury bond is structurally simple. You lend the U.S. government $1,000 today. They promise to pay you back in 10 years with a fixed rate of interest, let's say 5%, paid to you every year. Along the way, that is the deal. And for decades, this deal was considered the single safest transaction in the history of global finance. Not because the United States was perfect, not because the deficit didn't matter, but because, in theory, in the dominant financial theory of the post-war world, the United States government would always pay its debts. It had the reserve currency, it had the military, it had the economic debt. Default was unthinkable. And so countries around the world built their financial architecture on top of this assumption. Japan holds $1.2 trillion in U.S. Treasury bonds. The United Kingdom holds $895 billion. China, South Korea, Brazil, the Gulf states, collectively, foreign governments and central banks hold roughly $9.4 trillion in American IOUs. They bought those bonds because treasuries were safe, they were liquid, and critically, they were denominated in U.S. dollars, the currency that every country on earth requires to purchase oil, to settle international trade, to function in the global economy for decades. This system worked with a kind of elegant efficiency. The United States could borrow cheaply because demand for its bonds was massive and reliable. And foreign governments could park their national savings in a stable, interest-bearing, dollar-denominated asset. Everybody got what they needed. Everybody won. But here's the law that no financial system, no matter how dominant, no matter how deeply entrenched, can ever escape. Every system built on trust is only as strong as the conditions that produce that trust. And when those conditions change, the system doesn't adapt gracefully. It fractures. And right now the conditions are changing. The trigger is energy. More specifically, the closure of the Strait of Hormuz, the narrow choke point through which roughly 20% of the world's oil supply flows every single day. When that strait closes, it does not merely inconvenience the countries that depend on it. It cuts off their oxygen. It stops their factories. It grounds their shipping. It threatens to halt their power grids. And when a country faces an energy crisis of that severity, it needs dollars immediately because oil, regardless of where it is bought, regardless of what currency the seller prefers, is priced and settled in US dollars. You cannot buy oil on the open market with yen or won or dirhams at the speed a crisis demands. You need dollars, and you need them now. So ask yourself the question that every finance minister and central bank governor in an energy-starved country is asking right now. If you need dollars immediately, what do you sell first? You sell your most liquid dollar-denominated asset. You sell your U.S. Treasury bonds. This is not a theory. This is not a projection. The foreign central bank holdings of U.S. Treasuries at the New York Federal Reserve have already dropped to their lowest level. Since 2012, countries that are short on energy and desperate for dollars are selling American government bonds into the open market to raise the cash they need to purchase fuel. This is happening right now while most people are watching cable news and arguing about things that do not matter. Now, I want you to understand the mechanical consequence of this with absolute precision, because this is where most people's eyes glaze over and they start to lose the plot. Bear with me, because the numbers don't lie and this part is everything. When many sellers flood the market with the same asset at the same time, the price of that asset falls. This is not a controversial statement. This is the most basic law of markets. When the price of a treasury bond falls, something counterintuitive happens to its interest rate. The interest rate goes up. Wall Street calls this the yield. And the relationship between price and yield on a bond is inverse. When one rises, the other falls, without exception. Let me make this concrete for you. Imagine I lend you $1,000 at 5% interest for 5 years. 2 years into that arrangement, I get a sudden cash call. I need my money back immediately, but you do not owe me the principal for another 3 years. So I go looking for a third party to buy the loan from me. But that third party can smell my desperation. They know I need the cash today, and so they do what any rational actor does in that position. They extract a discount. They offer me $800 for the $1,000 loan. I take it because I have no choice. Now think about what just happened from that third party's perspective. They paid $800 for a loan note that will pay them back $1,000 in 3 years, plus 5% interest every year along the way. Their effective return, their yield just went up dramatically because they paid less for the same stream of payments, and they did not even have to negotiate. They simply waited for my desperation to do the work for that. Now scale that single transaction to the level of nations. Japan, desperate for energy dollars, begins selling its $1.2 trillion in treasuries. The UK, similarly squeezed, begins selling its $895 billion position. South Korea, the Gulf states, every country staring down an energy crisis and needing dollars immediately. All of them selling U.S. Treasury bonds into the same falling market. Bond prices drop, yields climb, and Treasury yields, as I need you to understand, are not merely an abstract number on a Bloomberg terminal. They are the foundation. They are the baseline from which every single borrowing cost in the American economy is calculated. When Treasury yields rise, mortgage rates rise, car loan rates rise, corporate borrowing costs rise. The cost of refinancing the federal government's own debt rises. Everything gets more expensive, all at once, in every direction. This is the spiral, and once it begins in earnest, it is extraordinarily difficult to stop. Now let us talk about the UAE, because this is where the story becomes not merely economically significant, but strategically fascinating, and frankly, a masterclass in the exercise of financial power by a party that understood its leverage completely. The United Arab Emirates is not a poor country. I want to be absolutely precise about this, because the word lifeline that has been used in reporting might lead a careless reader to imagine a nation on the brink of insolvency. That is not what happened. The UAE holds roughly $95.6 billion in U.S. Treasury bonds. It controls approximately $270 billion in foreign exchange reserves, and through its sovereign wealth funds, chief among them, the Abu Dhabi Investment Authority, one of the largest investment pools on earth. It oversees trillions of dollars in assets. The UAE is not broke, not by any reasonable definition of the word. But here is the distinction that most people, including, frankly, most financial commentators, do not make. And it is a distinction that changes everything. The difference between net worth and cash flow. The UAE is fabulously wealthy in terms of net worth, but the Strait of Hormuz closure did not attack its net worth. It attacked its cash flow, the oil revenues that fund the UAE's government budget, that pay its public sector salaries, that service its domestic obligations. Those revenues stopped. And when your cash flow stops, regardless of how wealthy you are, on paper, you are facing a liquidity crisis. You begin to draw on savings. And this is where the UAE's position became quietly an act of strategic coercion, dressed in the language of a request. Because if the UAE had simply solved its cash flow problem the obvious way by selling its most liquid dollar assets, meaning its $95.6 billion in U.S. treasuries, it would have dumped tens of billions of dollars worth of American government bonds onto an already stressed market at the worst possible moment. Bond prices would have fallen further. Yields would have spiked. The debt spiral we just described would have accelerated, and the UAE would not have been a victim of that spiral. The UAE would have been the country that started it. They understood this. And so, rather than acting unilaterally and triggering the very crisis they knew Washington feared, they went to Washington first. Their message, stripped of every diplomatic courtesy, was this: we did not choose this war. We did not close the Strait of Hormuz. We have obligations to meet and a cash flow problem to solve. And if you do not give us a mechanism to solve it quietly, we will solve it loudly on the open market. And you know precisely what that means for your bond yields, your mortgage rates, and your government's borrowing costs. So let us find a better solution together. That is not a request, that is leverage. And it worked because it was true. The solution Washington offered, or more precisely, the solution Washington was effectively maneuvered into offering, is called a currency swap line. And I'm going to spend some time explaining this because I am now convinced that swap lines will be one of the most consequential financial mechanisms of the next 12 to 24 months, and almost nobody outside of central banking circles actually understands how they work or what their long-term implications are. A currency swap line is, at its core, an emergency credit facility between two central banks. The mechanics are straightforward. The U.S. Federal Reserve agrees to lend dollars to a foreign central bank. The foreign central bank pledges its own currency as collateral, locked at a fixed exchange rate at the time the deal is struck. The foreign central bank takes those dollars and uses them to address whatever crisis is draining its dollar reserves. When the swap matures, minus when the loan comes due, the foreign central bank returns the dollars with interest and receives back its own currency at the same fixed exchange rate that was set at the beginning, regardless of how either currency has moved in the intervening period. The exchange rate risk sits entirely with the Fed. Now, the United States has deployed swap lines before. In 2008, during the global financial crisis, swap lines were opened with 14 central banks simultaneously. In 2020, during the pandemic-driven dollar shortage, they were deployed again. And in both cases, the official position was that these were temporary emergency measures, that they had been repaid, and that they had served their stabilizing function and been retired. The numbers on the surface supported this narrative. But here's the detail that nobody talked about at the time and that almost nobody remembers now. In 2013, the Federal Reserve quietly converted its swap lines with 5 central banks: the European Central Bank, the Bank of Japan, the Bank of England, the Bank of Canada, and the Swiss National Bank, from temporary arrangements to permanent standing facilities. Permanent, I am not sure there's a meaningful functional difference between a loan that never gets paid back and a loan that never matures, but I will leave that judgment with you. What I will tell you is that this 2013 precedent is not an anomaly. It is a template, and that template is about to be applied at scale. Here is my prediction, and I want you to hold me to this. Over the next 12 months, the swap line program will expand dramatically. Countries that have never previously been eligible for these emergency credit facilities will be brought inside the tent. The criteria for eligibility will broaden because it has to broaden, because the alternative, letting dollar-starved nations sell their treasury holdings into a falling market, is a crisis the United States cannot afford to trigger or permit. And as the list of eligible countries expands to include less stable economies with less reliable currencies, the fragility of the overall swap line architecture will increase. The loans will roll, they will be amended, extended, and the fiction that they represent temporary emergency measures will be maintained for as long as politically possible. Wall Street has a term for this practice. They call it amend, extend, and pretend. You amend the terms of a loan to extend its deadline in order to pretend that the underlying problem has been resolved. It has not been resolved. It has been deferred, and the bill has been made larger. The evidence that this prediction is already materializing will be sequential and visible. First, the UAE will receive its swap line. Then Kuwait will be next in line. And Kuwait's situation makes the UAE's look manageable. Oil revenues fund roughly 90% of Kuwait's government budget. In April of 2026, Kuwait exported 0 barrels of oil, not a reduced number, not a disappointing quarter. 0 for an entire month. That has not happened in over 30 years. Kuwait holds $66 billion in U.S. Treasury bonds. Those bonds represent not merely an investment but a loaded weapon. If Kuwait is forced to sell them, the market impact is immediate and severe. Washington knows this, and so Kuwait will ask, and Washington will again face the same binary that faced with the UAE. Lend them the dollars quietly or watch them sell treasuries loudly. The answer will be the same. Now, I'm going to tell you something that the financial media is not telling you clearly enough, and it is the most important thing I will say in this entire video. All of this, the UAE, Kuwait, the swap lines, the Strait of Hormuz, the treasury yields, all of it leads to one place, and that place is your wallet. You are either paying attention and positioning yourself ahead of what is coming, or you are going to be standing in the rubble afterward, wondering what happened to your purchasing power, your mortgage payment, and your retirement account. I don't care about your feelings. I care about your money, and you should too. Here is the transmission mechanism in plain language. When treasury yields rise, and they are rising, every interest rate in the economy that is benchmarked to those yields rises with them. Your mortgage rate goes up. If you are carrying a variable rate mortgage, your monthly payment is already climbing. If you are looking to refinance or buy a home, the rate you are being quoted today will be higher than the rate you were quoted 6 months ago and lower than the rate you will be quoted 6 months from now if this spiral continues. Car loans, the same. Credit card interest, most of which is already criminally high, climbs further. Corporate debt becomes more expensive, which means the companies you work for, invest in, and buy products from face higher costs, which get passed to you in the form of layoffs, reduced margins, or higher prices. And the United States government itself, which must constantly refinance its existing debt as it matures and issue new debt to cover its ongoing deficit, faces higher borrowing costs that require to either cut spending, raise taxes, or, most likely, borrow even more at even higher rates to cover the difference. This is the debt spiral. It is not hypothetical. It is arithmetic. Now, cash, you are sitting in cash and you feel safe, you feel liquid, you feel responsible. Listen to me very carefully. Cash is trash, not because cash has no value in the short term, it does, but because the real purchasing power of your cash is being eroded right now by the same forces we have been discussing. When the government is forced to offer higher yields to attract buyers for its debt, and when that dynamic persists, the long-term pressure on the dollar's purchasing power is relentless. The people who are winning in this environment are not the people who are waiting. They are the people who are positioned in real assets, assets that generate income, assets that are insulated from the bond yield spiral, assets that appreciate when the dollar weakens. The people who are losing are the ones sitting in savings accounts congratulating themselves for being conservative, while inflation and rising rates quietly amputate the real value of everything they have saved. You need to understand what the winners are doing differently. They are not panicking. They are not liquidating everything and hiding it under the mattress. They are studying the mechanics of what is happening, exactly what we have been doing in this video, and they are making deliberate, mathematically informed adjustments to their portfolio positioning before the next domino falls. They are looking at real assets, at income-generating positions, at the relationship between bond yields and equity valuations, and they are acting with precision and urgency. That is the difference between a winner and a victim. The victim waits for clarity. The winner acts on intelligence before the crowd sees what is coming. The numbers don't lie. And right now, the numbers are telling you that the system that has kept borrowing costs low and financial markets stable is under a form of stress it has not experienced in a generation. The UAE was the first visible crack. Kuwait will be the second. After that, the list of countries in the same position will grow, and with each new entrant into the swap line program, the implicit obligations of the United States expand and the fiction of stability becomes harder to maintain. You are not being paranoid for paying attention to this. You are being rational. The ones who are being irrational are the ones who are not paying attention. Let me close with this, and I want you to hear every word. Right now, in this moment, you have a choice to make, and it is the same binary choice that defines every period of financial upheaval in history. You could be the person who understood what was happening before it was obvious, who positioned themselves with intelligence and discipline, and who came out the other side of this period with their wealth intact and in some cases expanded. Or you can be the person who ignored the signals, who assumed that because the crisis was not yet front page news, it was not real, who stayed comfortable in their current positions right up until the moment they could no longer afford to be. That is the binary. Winner or loser, investor or victim, the person who acts on intelligence or the person who reacts to disaster. The first domino has fallen. The UAE has walked into the United States Treasury and made clear that the stability of the American bond market is no longer something that Washington controls unilaterally. It is now something that must be negotiated, managed, and increasingly subsidized through an expanding network of swap lines and emergency credit facilities that the public does not understand and the media is not explaining. Kuwait is next. The countries that follow Kuwait will form a line, and each new entrant into that line will add pressure to a system that is already under stress that most people are not watching closely enough. You've been watching closely. You now know what most people do not. The question is whether you are going to use that knowledge or whether you are going to close this video. Go back to whatever you were doing and pretend that the first domino did not just fall. Stop being a victim. Take this information, share this video with every person in your life whose financial future you care about, and hit subscribe so that when Kuwait makes its move, and it will, you are not hearing about it for the first time. You are already prepared. The dominoes are falling. The only question is which side of them you are standing on.